Hello, everyone. It's your mentor again, Brainiaker. And I just feel inspired to have this recording and have this particular session. I don't know how long it's going to take. I just want to explain as we move on. There are a few things that over time you get to understand as you practice. Coming into my mentorship, a lot of you you know, had a fixed mindset towards, so I'm going to take Brainiac mentorship and I'm going to become profitable. Over time, you then start to realize, yes, I need to put in the work, not just looking at Brainiac courses or not just listening to Brainiac talk. I need to put in my own work to see result. And along the line, you felt like, oh, I know these things, but it's not working. Now we're going to go into this like an elementary school. I don't know how long it's going to take, but I wish we can use up to an hour in this session. If we get to use an hour, it's fine. If we get to use 30 minutes, it's fine. Depending on when I feel that they need to stop, right? So when you want to trade and when you go into the foundation course, everything has been, everything has been made step-by-step guide for you. But this time around, I'm coming from the perspective of elementary explanation, right? What I mean by elementary explanation, right? I'm coming from the perspective of elementary explanation. A lot of you, when you get to college, right? There's what we call course code and the topic or guide or outline or whatever it is. So in this course, you have, a step at which you move further. So while we are looking at the mentorship, you basically have been familiar with the course outline, the foundational course one, the Elite mentorship, and the 2024 course. You are familiar with all of this. You watch all of this. And it sounds to be bulky for you. You don't know when to put this here. You don't know when to put this here. Now, for instance, that's why I said it's going to be an elementary explanation. For those of us, or for those of who understand chemistry to an extent, you know quite well that a standard acceptable reaction anywhere in the world will lead to the same thing, right? So that is why we want to have this. I hope it doesn't bore us, right? I hope it doesn't bore us along the line. So what I'm trying to say is, no matter how you learned or how you plan to learn, if you look at chemistry, for instance, and this is where I think it makes a lot of sense for me to give you elementary explanations, and we should come into a fixed, we should come to a fixed outcome, which means that we are going to have something defined and everybody should be able to see the same thing, which is the idea I want you to take away from this mechanical approach. Yeah, the right word should be mechanical approach. But how do we tend to have a general mechanical approach? It's understanding the elementary explanation. So about the XMC that we treat. So in chemistry, we have what we call chemical reactions, right? We have what we call chemical reactions. And the reason why I'm using this in chemistry, for example, we have what we call chemical reaction. We have what we call chemical reactions. And chemical reactions as a standard approach, which means, for instance, let's use the generic things we are familiar with, elements and compound we are familiar with. We know that we have what we call water, right? Water is just everything a lot of people have. So we have water. So we know that things come together to give us water. We know quite well that things come together. Elements come together to eventually give us water. So what are those elements? They are fixed. They are not. They don't differ. So we have them to be, hydrogen and oxygen. These are just the pure element that come together to in the chemical reactions at which water is formed. So we have hydrogen, and oxygen right there. People would say, Brother, why are you coming back to this? You will understand the reason why I have to make this elementary explanation before we move into the main outline of trading SMC. So we have it as hydrogen and oxygen. But we are coming from how do they react to eventually give us water? Now, standard everywhere in the globe, in UK, in US, in Japan, in Australia, in Canada, in Nigeria, in Ghana, everywhere. We know these basics. They are basic things. Hydrogen and oxygen have a chemical reactions to lead to water. Then it comes to at what proportion of this chemical reaction do we eventually get to have water? So we would say, reactionary, we can say hydrogen plus oxygen. We can see hydrogen as H plus oxygen right there plus oxygen is now going to give us what we lead to as water. Let's have it as H2O, right? So this is the chemical symbol for water, right? H2. So these are elements which makes up a particular compound. When two elements come together, they become a compound, right? So two or more elements come together, they become a compound because it's no longer one, it becomes 2, 3, 4, 5 elements. But then this is what comes together from H2, but they are not yet a balanced equation. So that is where we come to a balanced chemical equations. So if you take this equation to anywhere in the world, this particular equation to anywhere in the world, and say this equation is going to give us water, what they will tell you is that this is not a complete equation to give you. Hydrogen plus oxygen will not literally just give you water. They have to be a condition at which they give you water, right? There has to be a condition at which hydrogen and oxygen give you water anywhere in the world. If you take this out to people and say this is water, this is the chemical reactions for water, or the chemical equation for water, everybody that studies science, even basic elementary science studies, will tell you no, this is wrong, you can't have this. Now, why are we saying this? It's coming to the understanding of how you trade SMC. As Brainiac, people would say, understanding of SMC, it doesn't have to be similar, it doesn't have to be the same, but the basic, the elementary of it, you need to know it, they have to be similar. How you explain, how the next person see it, how the next person sees it, you have to see the same thing at a point in time as a community in prototype mentorship, which means you need to understand the foundations that Brainiac has given to you. It is standard for you to know that. If you then do not know that, if you give a structure to someone on trading, and let's say I'm using two persons in my mentorship now, let's say Benga and James have a setup. They are looking at it. They can tell what each other is looking at just by looking at their setups. They can tell because they have the same foundational knowledge of what I'm trying to explain. So when one is doing something wrong, they can both know that this doesn't make sense, right? They can both know because they have the same foundational level of knowledge in terms of how SMC has been seen in our mentorship. I'm using my mentorship as the basis of my explanation. Right? I'm not talking about anybody's mentorship. I'm not talking about this mentor, this guru. I'm talking about Pro Trade FX itself. So when you're in my mentorship, you have the same understanding of what I'm explaining. If you see a setup, you can explain to another person and say, this is what Brainiac is looking at, foundational knowledge. And this is what this means. If I'm writing hydrogen plus oxygen equals to H2, and I give it out to another science student, it's going to tell me, Brainiac, this doesn't make sense. This is a complete chemical reaction to give me H2O, which is the water. Something at a quantity must react to something at this quantity to give me a perfect or balanced equation. And the same thing is applicable to trading SMC, the way we trade it, right? We are not just going to neglect the basics. And what are the basics that we need to know? We need to understand the 3 steps in which we have been explaining all of this. Why? These are the things that are the foundational knowledge of the way we trade. This number 1, and we've been talking about this so many times. We've talked about structure in a language that has been explained so many times. We've talked about structure in itself. We've talked about liquidity. And we've talked about point of interest, which is primarily our basis of entry. These are the things you want to understand depthly. These are the things you need to know in a very big depth, right? So when I am going to explain, or when you're going to see my markup, or when you're going to see my setups, you can then tell me, Brainiac, yes, I think I know what you're looking at. Brainiac, I think I have an idea of what you're looking at. So, but when you have flawed in the explanation of the whole structure, liquidity, point of interest, it boils down to, someone who does not even have the foundational knowledge of hydrogen and oxygen leads to give us a chemical reaction of water. So when you do not have this knowledge that water in itself comprises of hydrogen and oxygen, all right, you would not even know H plus O is not equals to H2. You would not know that is not a balanced chemical equation. And that is what I'm trying to tell you in terms of elementary explanation. But the moment you know that, okay, I have an understanding of structure, I have an understanding of liquidity, my point of interest, however way I want to look at it, maybe MNSR, which is Malaysian support and resistance rule for entry, maybe aggressive entry, maybe conservation entry, maybe other block entry, maybe favor lookup entry. That's just another explanation of entry on its own. But the basis of everything that you need to know within SMC is on your structure, liquidity, and your point of interest. So when you do not know all this to the depth at which you should know it, you will have a problem interpreting what I put out there. You will have a problem trading the way I trade. You will have a lot of problem trying to find balance within what I know and what you're seeing. Let me recap what that means. So when you do not have the explanation, or when you do not have the elementary knowledge that hydrogen and oxygen react to give us water, you would not even know if this is a balanced chemical equation or not. So someone who do have a big understanding of what the chemical reactions of H2O means, then we now tell you that, you can have it as what? Hydrogen gas, right? So you can have it as an hydrogen gas in terms of a balanced chemical equation as 2H2 gas, subscript and superscript. So my keyboard does not have that, so I'm going to use that as this should be below H, and we have O2, right? Oxygen. So yeah, they both are in gaseous states, right? And this could be also, so that's just a balanced chemical equation in terms of how perfect it should be. It could be in liquid form, and it could be in both. All of these are in gaseous states, and this is in liquid or gaseous state, depending on how it is being formed to react to give the final product. So this is going to be the balance equation, the final product, right? Which is in blue. This is going to be an incomplete reaction, right? It's an incomplete reaction. It's not complete, right? And this is going to be a complete reaction. So someone can tell me that, okay, Brainiac, this is a complete reaction and this is not a complete reaction. That is elementary. That is the basics of, chemical reactions. You need to know the basics. So if you do not know this, you can't know this. If you can't know this, you can't know this. So which means that if you do not know this to the depth at which you should know it, you're going to have a problem along the line in understanding the complexity of what structures could be and how should you mark up a perfect structure. When we explaining all of this, we've talked about how complex structure can be, how complexity of market structure. Complexity of market structure. Now, we've talked about structure could be bullish, could be, those are just a defined trend of structure. But in itself, we have structure to be probably internal structure external structure, ranging structure. That in itself is where the complexity of structure play a major role. When we talk about all of this, I've always said in most of my statement that when you understand structure, everything becomes easy. You know where your internal liquidity becomes. And I'm a kind of trader who always want to simplify things for you. I don't want you to do further mathematics on trading. I do not want that. I do not want you to start reading 3 candles to know which one is the open of this candle, which one is the close of that candle. I don't want you to do that. I want you to make it simple, because without the intervention of candlestick, people still trade. Now imagine when there was no candlestick, people still trade, right? It means that without the candlestick, there's a line chart, there is a bar chart, and there's all of those charts that can interpret price action without candlestick. So candlestick in itself is not the sole interpretations of price. Candlestick in itself is not the sole interpretation of price. Whatever your candlestick is telling you, if your candlestick is showing you this, right? Let's say this is a candlestick. Your line chart is going to do the same thing. So how you interpret the candlestick within that trend is up to you. It doesn't concern the market, right? And what I mean in this situation is that if you look at this, right? If you look at this quite well, this is a candle, right? This is a candlestick price action. It's in itself, the trend is bullish. In itself, the trend is bullish. If I change to a line chart is also bullish. So people would interpret this the way they want to if there was no candlestick, and they will still be profitable as much as anything. The introduction of candlestick just make things more complex in such a way that everybody wants to read every single candle, which is irrelevant. It doesn't really matter. So it is in our best interest that we do not want to complicate what is already complex, because market trading in itself is a complex system. So you do not want to complicate, starting to read why this candle is this, why this candle is formed, why these 3 candles has to close below this and that and that. It's already a complex system. Now, what we've tried to do in the mentorship is to make sure that we simplify the complexity of market structure. Does that make sense? I wish that actually makes sense. The way I just said it is to simplify the complexity of market structure. So, and how do we do this? We pay more attention to what we look at as when we talk about market structure. Remember I said we can have it in market trend, right? We can have structure in market trend, which is the type of market trend, which is a bearish market, bearish structure, and bullish structure. Everybody can understand when we have a bearish structure and when we have a bullish structure. And where we have made it so simple is where we then start to, where it has become so complex is when we now start to talk about the external range structure and the internal range. And what does this mean when we're looking at the range? When we talk about range, and I want you to see price and why we use internal range structure and external range structure, or external structure, internal structure. It's up to you how you define it. A range has to have a start and need to have an end. That's a range. So when we're talking about range, you talk about from a significant point A to another significant point B. So whatever it's within this point A and point B, it's a range in itself. So you want to work with a certain range. And that is where we come in with simplicity of market structure. In such a way that we can identify an external range and internal range along a particular market trend. If market is trending all the way from here, let's go to the chart. If market is trending all the way from all of this, from this low, right, down into, let's say, this high, we don't have to interpret all of these things. We need to pick a range. We need to work within a market range. Right? We have no business wanting to interpret all of this. This in itself already gives us a clear interpretation that we are bullish. And where the complexity comes in is now, bring up now, we don't have to work with all of this. Where is the point we have to work with? And that is where we talk about market range, internal and external range. So we can then take a particular recent price action and say, okay, I'm going to use this to define the point at which I'm looking at market. That is where you can then say, okay, I have a range that I can work with, I have this that I can work with. If you don't have that, you are going to have a problem defining market structure, as complex as it may be. And that is why you would see a lot of retail, when they want to simplify their own, they make use of the trend line, in which it's simplified by this, by trend line, because trend in itself is a line. This line, the reason why it is called trend line is because in itself it's a line, for those of us who do mathematics. Right? So we understand mathematics rather. Trend in itself, the reason why it is a trend line is because it's initially a line. So at what point is this line? What direction is it trending? A bullish direction. It's as simple as that. So we can easily use this to mark at this point, this one point, this next point, this next point. We can use that to identify every pivotal point of the trend and how they react to this point. So we can use that. So it is easier for retail to use candlestick as, to pick a large range of candlesticks to define their trend. But for SMC, we do not need to go through the orders of using all of those data. We do not need all of these data to define a particular range we're working with, which means I could just pick where we had a recent break of structure, which is my previous high and my previous low. This is my previous high. This is my previous high. And this is my previous low. I could pick these two as my working range. The moment we broke above that high, I would know that now the next low, which has failed to break below the low, is now my working range, which is now a high and a low. That is now the next range at which I am working with. I do not need all of this. And this is where we'll talk about complexity of market structure. Now that I don't need this, I know this is my previous high that was broken, led by this low, and it was broken higher. I know that we have now a break of market structure, which is most likely your break of, your BOS, break of structure. This can be a break of market structure. So we have that significantly as a break of market because we've taken out the high. And why does it become a break of market structure? Because the price at which this candle was before was different from the price at this candle. And the details of price action that we have here would not be printed so well if it was line chart. Yes, line chart does the same thing. You can see even without coming to candlestick, other things we use our candlestick for is just a point of, let's say, when we are looking at the point of demand, where we have more voluminous candle. And those are the details that candles can tell us. We do not have to make it so complex that understanding candlestick in itself becomes a work for us. And when it becomes a work, interpreting that becomes more harder and it becomes more complex. And that is where we come with the conclusion that we want to simplify the already complex system, right? So now we have a data that we can work with. So now let's go back to what I'm trying to explain to you. Now we've talked about structural liquidity, point of interest as the basics of what you need to understand. And now on market structure, we've talked about the market trend, bearish structure, bullish structure. It's already established. Within that trend, we have now the external range structure and the internal range structure. Now, what did that mean is that within the bearish trend or bearish structure or the bullish structure, we have both the external range structure and the internal range structure, which is present. If you go back to previously as a retail trader, in wave theory, we have what we call, in wave, we have what we call impulse and corrective wave. Impulse and corrective wave. So within that impulse and corrective wave, we have the primary trend and we have the secondary trend. So within your primary trend, which is the impulse, you can also have a complex structure. And what does this mean in itself is that when you're looking at market, you see that we have, let's say, market is giving us this, right, which is trending. And okay, I have to go back because of what I deleted. Yeah, this impulse corrective wave. So I have to put that back. So if we have it like market is going, impulse corrective wave. These are impulse. The one that aligns with the trend, they are impulse. The one that doesn't align with the trend are corrective. Impulse correction, which is also known as retracement. But when we're looking at the market structure range, we are talking about range of impulse to be from this low to this high. The range of what? Of the impulse to be from this low to this high. Range of impulse from this low to this high. So that's your range of impulse. Range of correction to be this one that we now have as black. That is going to be your range of correction. Range of correction. Now, what I want you to take away from here is that within the leg of our impulse, within the leg of our impulse, we are going to have also other price action, which is going to be on other time frames, which can be subtle or not too much weak if we, depending on how lower we go on time frames. So within this also, we're going to have impulse correction, and this is where complexity play a major role. The more you start to go lower time frame, the more new price actions start to unfold along the line, the more new corrections and impulse start to unfold, and that itself is also going to lead to you having another type of range structure. So let's say you are coming on the 4-hour, you have a big market structure, right? So you've defined your range on 4-hour, knowing that this is your low and your high of that range, and now you know that everything that is inside of that range is internal range structure. But as you go lower on, let's say from the 4-hour, you then go to, let's say, the 30-minute. Let's say you come down to 30-minute. There's going to be a time where from your low, there are so many things going on before every single movement to the upside. There's so many price actions going on. So those price actions can lead you to, oh, Brainiac, I have so many other blocks here, I have so many demand level here, which one should I pick, which one should I not pick? And that is the complexity of what, external range and internal range can give to you as you move lower. But how do you make it easier? Making it easier knowing that if you are dealing with higher time frame, you want to deal with the one that is mostly significant. You leave the one that can lead to noise on lower time frame. What that means with noise, these are what? Lower time frame noise. Not noise in itself per se. It means that there are still going to be so many things going on within the range of lower time frame price actions on that time frame. Remember, we are talking about 4-hour candles. For every candle that are close to 4-hour, every candle that close to 30-hour. So in 4-hour candles, you have 30-minute candle. All right, 1 hour we have 2 30-minutes, right? So in 4-hour, we are going to have 8 30-minutes, right? So 30-minute candle in 8 places inside the 4-hour range for just one candle. It means there are still going to be more micro informations within the 30-minute structure, which makes it now complex for you to digest as a new trader. But what you want to do, you want to define and stick to the one that matters, which is your 4-hour, then canceling out the noise of the 30-minute complexity. I wish I can show myself the way I am using my hand and everything to explain this, because I feel that will make sense, but probably unveiling will be anytime soon, but not yet. And if you understand this complexity as they exist. Yes, the market is complex. When you move to lower time frame, it is you admit that it is. You do not want to fight it. You do not want to oversimplify it. You do not want to make it too much complex for yourself. Then my go-to advice is what? You stick to the one that makes more sense, which is the higher time frame. 4-hour, 2-hour is okay for you to define a point. So now, that being said, we move on to, because now the reason why I don't want to go into more of that is because already you know what structure is from the foundation course, from the elite course, from the 2024 course. I do not have to tell you the higher high, higher low, higher high, higher low, and this. Then liquidity. We've talked about liquidity in all of these courses as well. We've talked about it. But where does it become complex? It becomes complex when you could not identify your drawn on liquidity, which is your potential target, and your objective, which is also your target, then your inducement, right? Liquidity has been very much simplified, which could be anything. Attraction of price, right? Liquidity is what? Attraction of price. Why is it an attraction of price? Now, this explains it. Liquidity is what? Attraction of price. Why is the attraction when we talk about liquidity? Liquidity is money. In market terms, money. As simple as that. Be it, why do we call it an attraction of price? Number one, either we call liquidity as inducement. Inducement. Either we call it as trap. Either we call it as DOL. With DOL means drawn on liquidity. DOL, which is, either we call it buy side. Either we have it as sell side. All of this mean one thing. It means there is a volume of money sitting at those level. It is a volume of money which market is going to take, which market is most likely going to move into. The reason why we make this terminology, not because it is the standard to say there's a liquidity here. Who put it there? You don't know who put liquidity there. The market just don't just dump liquidity everywhere. The reason why we make this statement is to make logical sense as to why price move the way they move. The banks is not going to sit on their screen and say, yes, this low candle has a liquidity. Or let's say we are looking at candlestick ourselves. The bank are not going to come here and identify liquidity and say, oh, yes, we have liquidity here. We have liquidity here. The bank, let's go and target those liquidity. No, they're not going to do that. Because they won't use this data that we are using. They won't use this candle. They have big and more information at hand, more software to analyze better than we do. Not just candle that we are looking here. It doesn't tell the details of the volume in price. It doesn't tell the details of each candle has a particular volume attached to them, which means the number of supply in this candle or the number of demand in that candle. It's not well told by just looking at it with our eyes. So they are not going to be sitting on their screen and start to say liquidity is here. The reason why we say what we say is to make logical sense and say, yes, I think this makes sense. Over time, as we start to see it as, okay, if we have structure like this, and most of the time, when we start to see that this low is intended to be at a point of inducement, which is in itself liquidity, we make a case to sound logical. Yes, we are bullish. We know that we are bullish. To sound logical to why retracements stop at where they stop, we are going to say, yes, we are having a point of retracement, right? We are then going to tell ourselves, yeah, I think the reason why we come lower is here is because this is the last point of support. There's going to be some money sitting at the last point of support. Let's wait for market to take this money before they drive up. And when we look at price as they move, this explains the reason why retracements pull back from where they pull back. When we are going to, the basic retail terminology, we use what we call the Fibonacci retracement. At certain price level, we expect price to, and this is what I mean, at certain price level, we expect price to pull back. We expect price to pull back at certain price level, which means at 100% of the price, we are premium. At 39%, we are premium. 78%, we are premium. 61%, we are at slightly premium price. 50%, we are discounted or equilibrium. Then below 50%, we are likely going to be at discounted. So when price move from this point down to, from 0 down to 100, we assume technically. Because to me, it's going to be a data assumption. It's not going to be a verified assumption. And over time, when you assume something to do what it is, and they keep doing that, it becomes what you work with. Might not necessarily be the right information, but the fact that data backs it up with, okay, at the point of 50%, I think price tends to go higher. And over time, you have a lot of, let's say you've backtested 100 data, and 70% of the data confirm what you already backtested or what you already know to be a theory. It becomes something you use as a tool or as a strategy for reaction. So if you're going to look at it from this perspective, you can say, okay, at discounted, people buy. Why are people buying at discounted? Because it is cheaper. This is price we are talking about. Why does it make sense to buy at discount? Because it's cheaper. Why does it make sense to sell at premium? Because it is higher. The more it's dropped, the more you make more money. Because you've already sold at premium. So why do you buy at discounted? Because it's cheaper. The more it goes higher, the more you make profits. So it makes more sense from that perspective of what? Of Fibonacci retracement. Because we are looking at the amount of retracement it will take for price to go into either discount or premium before they can push back up without putting into consideration liquidity. Liquidity in itself is money, yes, but at what point am I willing to buy or at what point am I willing to sell? That is where Fibonacci comes in. And it makes logical sense. Now, this is logic. It makes logical sense and it becomes a data that you work with. Now, when we are talking about liquidity, now we've talked about, okay, I think this makes sense. And when we go to price and we start to see it happening over and over again, we start to see that when price prints a low, they have a pullback and they go higher, the retracement that we are going to have next is going to be below the pullback. And with that, they can then move higher. That makes a lot of sense to us now, because we've said when we have our impulsive move from one range of level, from the low and the high, and the price is coming backward, we want to see that liquidity from that level is taken, which also makes sense, remember, with our Fibonacci. And when that happens, we expect them to continue knowing that the price is bullish. And that doesn't make sense with Fibonacci. It means that if we are considering Fibonacci to be at a range where it is discounted, we know that it is below 50% of that price and we can buy. It makes logical sense. Liquidity, yes, when they come here, we know that this is an area of support. There's a money sitting down at those points. Can we expect price to take those support a bit as stop points, as liquidity taking, as inducement that should be taken before price move to the upside? Yes, we call it inducement. Now, if we look at our range of price from the high to the low, we can say at 100% price is then retracing back. Let's take this back. So we are seeing that price is then coming from 100 down to 9, down to this, down to 6. So this is at 50% equilibrium. And we're telling ourselves the discounted price is coming down. At what point am I going to be buying? It doesn't make sense to buy here. It doesn't make sense to buy. It doesn't make sense to buy. At what logical sense does it make sense to buy? Below your 50% level. If you're going to look at deeper retracement level, it doesn't mean price cannot buy. It doesn't mean price cannot. But where does it make more logical sense as a business person? More discounted price. So, and this is not within more discounted. It is more like an equilibrium level. Now let's make sense. Let's wait for it to take that equilibrium and move into discounted price. Then we can buy. It makes a lot of sense logically. And this is what happens in that situations where this pullback, which is now our internal range inducement, and we know that we want to be bullish, and then we expect price to come here, and as price move below 50%, right there, from this high down into this low. So, and as price move into, you can see 50% is here. We allow price to take the liquidity at that 50%. Then what happens next? Price shoot to the upside. And this makes a lot of sense because by the time we continue to give it more logical explanation, and what we do is not working with a word-proven system. It's working with a system that is data-proven, which means it's something you have to backtest on yourself. If you now backtest and work with 100 data, and you can see out of the 100, 60-70% makes sense logically the way you see it, then that should be what you work with. And if you look at this, We've explained this. Now, this is where we break structure right there. And this is where we have a low. We break the next structure, we have a high. What's the next low? This. And we put back, we will add the Y. And we have this move here. Now, before we go into that, right, we have this pullback, we have a break of structure, which is this. We have a low, then we have the next one, pullback, we have a high. So this is our next low, right? So this is the low and the range you are working with. If we bring our Fibonacci back there, from the low down into this, our percent is somewhere around there. And we have lows which has been printed above the 50%. So which means all of this low, we are not going to work with them. We're going to work with something below the range of 61.3%, which means liquidity is where this is sitting, at that range. And what happens from that range, we believe that price is shooting there and continue to be bullish. That's another case. Now we have two cases within a certain framework. It makes sense now that we are working with range. The next thing is we are going to work with where is the next break of structure going to happen. Now that we've broken structure from this level, what are we working with? We are working with the next one, right? Remember that we've had a break of structure from this. Now, when we have a break of structure, low has been established, a high has been established, right? So what next? We see that as soon as we establish a high, we pull back, we break the next structure high. So now that we break the next structure high, we break the next structure high. Now that that has happened, we have now a low that broke the high. We have the pullback. We have another high. So high has been established and low has been established. So what happened next? We are dealing with what? This low, this particular low, and this particular high. And that makes it make sense that we then have a break of structure, right? From there, we then have a low like this that led to a high. Then we have all of this information to the high. So if we are dealing with this, we are telling ourselves, okay, we had a break of structure here, we had a low here, we had a break of structure here, we have a high. So this is our range now and a high. So if we are dealing with this, it means that what? This low is at what? Is at this particular low is at 50%. Which is now going to be our inducement as liquidity. And now we're talking about liquidity, right? So inducement in itself is liquidity. Drawn on liquidity itself, which our objective, is also liquidity. But this inducement can be referred to as an internal liquidity within the range, because we're looking at the range from the high, from the low down to the high. That's a structural range. And now we're looking at what happened inside of the range, internal range. Right? So we can then deal with, okay, what happened next? We put our Fibonacci, which is not necessary, but we want to make logical sense as to why we expect price to retrace down into those areas. So when we say that, we'd say, okay, we're going to view price from here to here. So at this point, is at 50%, right? So we know that there's liquidity lying at that 50%. So what happened, we want price to take that liquidity. So when price retraces, right? Yes, you can see we took some of our liquidity and we went higher, but we didn't break structure. So that has not established anything. We haven't completely broken structure. So again, we had more retracement into that. But remember, this is our low. And you can see that price did not take that. Price just came into that low. Let me put that into more part. Just came more deeper than we expected, which makes sense as well. Price could do that. You can see this is our low. We didn't take it when we came down there. We just came more deeper into that low. And which means the more we go into discounts, the better for profit, right? Your entry might be wrong and you can add more position the more you go, which is going to be what we call the dollar average cost. Right? As you go lower, you know that you are sure of the range and you want to look for more discounted price to buy. Then you had more position. Then you still verify that this is your low that is protected. As soon as price come into that low, even more lower than the inducement we expected, price will come there, led to a break of structure, new range has been established from this low down into this high. So then we can work with the next thing. Whereas the next thing, we can say your fib again from the low, from this level. Fib is not compulsory, but we are using this as a complete explanation to a range and where inducement can take place. Down into your low, where's your 50 cents? Yeah, right? We know that anything that can give us liquidity below our 50% is going to be where we consider our internal range. So if you look at this, this is an internal range. So you know that price could come more lower into this before we push higher. So you know that. So if price come into 50%, come lower a bit, that has given you what to work with. And you can see the more we push into that percent, price tapping more further. And we can see we came into what? We came into that. Even though we expect them to dip in more further, but look at our prices came into that, give us more confirmations and they long. And when we had a break of structure, what next? When we had a break of structure, that confirms the next range. And you can see that from the next range, again, this is our low and this is our high. Price at the pullback again came into the next percent of the candle, because now this becomes so messed up now. So we can take this. So when we look at where we had the next break of structure, look at how we define price within a certain range without having to draw line charts, without having to do this, without having to complete things. Where's our low? This low led to this high. So again, if you look at Fib, which is not necessarily, like I said, anything that has a pullback before your break of structure, so you have this, before your break of structure, you have this pullback. This becomes your inducement, right? Because we use our range as something like this. And we're knowing that pullback is our what? Is going to be our support level where they will be induced, because now they have to, people are looking for support to go on, but we want them induced before we go higher. Right? So if that is the case, we know quite well that if you use the backings of logical explanation into this, right, we're going to have it as, you're going to have this as below 50%, more discounted. You can see this at 50%. This is where we think we had more pullback or this level, and what happened next, price came into that more discounted below that. And what did they do? They continue to buy price. So liquidity in forms of inducement or in form of objective has to be logical for you to make that decision. Remember, we've said journal liquidity, trap, buy side liquidity, sell side liquidity depends on how you interpret price. Now we'll talk about inducement. We will talk about trap in other videos, because I think I've talked about trap in the foundations and the alerts. We talk about buy side liquidity and sell side liquidity. What is buy side liquidity? Understand that the name given to this are irrelevant. What price is going to do is what makes it relevant. If we are bullish and price is taking every high, the high become an external liquidity that is within a range structure. Let's say these are low, these are high, these are low, and every high is being taken. This high becomes your buy side. And as much as it's a buy side liquidity, it's also an external range liquidity. Because it's above, is something that happens within your external range structure or your structural leg. And when prices go in there, it's also a buy side because it's within the buy side liquidity. And when it is bearish, when prices are approaching every sell side, right, you will see that every low that will be taken become your sell side liquidity, becomes price creates a new low that is lower than that low, and a buy side price creates a new high that is higher than that high. They are just names given to them to make sense out of it. They are names given to price to make sense out of it, right? So when we talk about all of these things, it doesn't necessarily mean we want to complicate it. It means we want to make sense out of it. It means we want to make sense out of it. So again, the depth understanding of this, knowing when price is going to turn, knowing at what point you want to buy in continuation of a trend, knowing where liquidity lies in terms of inducement, and knowing where objective is in terms of buy side liquidity when it is bullish, or sell side liquidity when it is bearish, which is our objective liquidity. They're also liquidity because it is money that is sitting at the buy side, which is our external liquidity, and also money that is sitting at the sell side. Another form of liquidity that we'll talk about is your trap liquidity, which has been explained in Airlight and Foundation. So, point of entry. Oh, Brainiac, what do I use as point of entry? You don't use anything. You use what we've taught. Point of entry, you know quite well that we've fixed a rule that says we are going to have liquidity taking, right? And we are not going to be waiting for price to come there before we make a point of entry. Our point of entry is going to be at any other block below that inducement. So if price is going to take this liquidity, why not look for the next demand level? Why not look for the next SNL level? Why not look for the next key level that we reject price from there after the liquidity is taken? after inducement is taken. So that's what we do. We look for the next what? We look for the next point where liquidity is going to be taken. It's as simple as that. We look for the next point where liquidity is going to be taken, and we will position ourselves. It is not until when price then does that before we now start to look, oh, I think I missed out on this trade. Point of entry is where you wait for you to make decision. It is not until price gets into that point, then you start to think, oh, I think price will react here. Oh, I think this level is strong. Oh, I think you've prepared yourself. And that's why it's a point of investigation, point of interest, point of entry, point of anything. So entry is based on the parameters at which you see at that point that makes you think it's a valid area. So most of the rules that we've made for ourselves as a smart money trader is what makes a valid point of interest. Why is it a valid point of interest? Why should you think this point of interest should hold? These are the things, these are the questions you ask yourself. See, the problem we have is that when we listen to something over and over again, they become music to our ear. They don't make sense. They just become, oh, I've had it before. Oh. And the simple things we've had are the things that work. The simple things we've had, oh, over time, yes, this, they become music to our ear. Oh, I want to learn new things. Oh, I want to have new knowledge. You don't need new knowledge. You need to practice the one that become music to your ear. And that is the way you can grow along the line. I've been talking for long, and I don't want it to be too long as well, because people get boring. It becomes music to their hair when they become boring. So you want to make sure you understand this. You want to make sure that what you are learning and what you are applying is what you know. It's not just what I think I should do this. So what we are saying in simple terms, or what I am saying in simple terms, is that for you to do what I do, you have to have the knowledge, the foundational knowledge that I have. You have to understand these things the way I understand it, so that when we get to the application part of all of these things, when I am explaining, you understand what I'm explaining. When Benga is explaining, you have an idea of what he's explaining. When you see my chart, you can interpret my chart. When I see your chart, I can interpret my chart. I don't get lost within your chart, which means we have to come, just like when I explain chemical reactions. Someone in Japan will look at this and say, yes, you are right. Someone in Japan will look at it and say, no, you are wrong. This is not a complete reaction. Just the same way, when you mark a setup, I should be able to tell you, oh, you are wrong with this setup. When you look at my setup, you should be able to have an idea, I don't think this makes sense. And that way, we've come to more like a synchronized, a mechanical, and a rule-based approach. Because without the rule, we're all going to do different things. With the rules, we are going to follow exact same model, have the same repetitive pattern, and be able to do the same thing. No matter where you are, when you see my chart, you know what I see. You know what I'm buying. You know what I'm selling. You know why this point is valid. You know why this point is inducement. You know why this point is my point of interest. You know what structure is saying the way I read price. So you need to understand that without the knowledge within these basic things, the structure, the liquidity, the point of interest, every other things that you are going to build on it is going to be relevant, because the applications become more complex, because you don't even have the basic knowledge that will simplify the complexity of that for you. I hope that makes sense. I wish I'd be able to go on and do more videos, but take note of what I'm trying to say here. Study the basics one. Understand and look at the database that I've presented to you. Look at, if you go to this Discord channel, search for so many things, you will see all of these things that has been talked about, has been so many times discussed, and the same things, we do the same thing and over and over and over again. Even when you're making mistakes, and someone points out your mistake to you, the fact that they point out the mistake to you, oh, let's say I omit something like this. Look at what I'm omitting. There's 2 years before. Let's say I didn't omit the 2. And I showed someone and they said, Brainiac, oh, this does not make sense. 2H2 plus O, 2H2O. It doesn't make sense. I think you're missing something. And the person pointed that out to me. I would say, yes, yes, I'm missing something. I'm missing 2. Yeah, okay, let me add it. So same thing to here. When you try to interpret this in your own terms and you draw something like this, right? And you do this. Let's say you want to buy. And I'm seeing you, before price get here, I'm saying, oh, you make mistake here. Your entry should be somewhere here. And I point that out to you. The fact that I point that out to you, will understand why I point that. I said, oh, this is supposed to be your inducement. Take note of that. So you understand why I'm saying that. You know that, okay, yes, I think it makes sense for me to know that it's my inducement and price can take this out before they go higher. That is the way it should be. Because now you have the basic knowledge I have. You have the elementary knowledge that I have. You should be able to be in the same realm of knowledge. We should be able to be in the same realm of technical understanding. And if that is possible, that we come into the same approach, to the same system, we're able to do the same thing, replicate the same model, it becomes easier for us to become profitable. Don't look at the fact that people would say, oh, when the system becomes saturated, it fails. No. Even in a saturated system, not everybody will be profitable. In that same saturated system, nobody is after your SL. The banks are not after your SL. It's a multi-trillion-dollar industry. So nobody is after your SL. So what you should understand is the data you're working with, they are proven data. You've had it in your back test, you had it in your journals. Out of 10 trades, you won 7 in your journal. So when you are replicating it in the system, you know that yes, this is a data that has been proven by you, something you've worked with. So how well can you do with this data? How well can you follow the system judiciously without compromising what your data has said? I hope this makes sense to anyone listening. I hope if you want me to talk more about this, if you want us to go more into details about all of this and I've said in the next video, let me know what you think when you're done watching. I'll see you in the next one. Good luck and God bless you. Peace out. Peace and love.